Picture this. An old intelligence operative staring at a radar screen. Blips everywhere, chaos unfolding. But amid the noise, one signal stands out. Not the explosion, but the silence before it. That's Bitcoin right now, you plunging from $126,000 in October to scraping $85,000 by mid-December 2025. Headlines scream crash, bear market revival, the end of the bull. Peter Brandt warns of a $25,000 floor. Peter Schiff piles on, saying the pain's just starting. Even the Fed's whispering about a $3 trillion crypto collapse in 2026. It feels like a war zone, doesn't it? Prices tumbling like dominoes in a hurricane. Liquidations wiping out $1 billion in a single day. But hold on. What if this isn't a crash at all? What if it's the biggest trap you've ever seen? A meticulously engineered shakeout designed to scare you out of your stack while the real players load up in the shadows. You know the feeling. You've been scrolling X, seeing posts about Japan's Bank of Japan hiking rates on December 19th, the highest since 1995. Japan will crash Bitcoin, they shout. Carry trades unwinding, liquidity drying up like a desert mirage. And yeah, it stings. Bitcoin's down 30% from its peak. Ether's taken a 36% haircut. Strategy, that Bitcoin treasury behemoth, sees its premium collapse to 1.2x, stock plunging 63%. Miners like Riot and CleanSpark pivot to AI, drowning in debt. It looks bad, real bad. But let's zoom in on the strange price action. Why does Bitcoin drop $4,000 in minutes on a quiet Sunday? No major news, just poof, $139 million liquidated. It's not random, it's surgical. Think of it like an iceberg order in the depths of the ocean. You see the tip, the violent dump, but below, massive bids stacking up. Forensic proof? Look at the on-chain data. Dormant wallets from 2013 lighting up, scooping millions in BTC at these crash levels. Whale addresses, those holding over 1,000 BTC, up 5% in the last month alone. While retail panics, institutions like BlackRock's ETF inflows quietly hit $50 billion year to date. But skeptics say, nah, it's just leverage unwinding. Sure, $1 billion in longs and shorts got wrecked, but why the asymmetry? Long liquidations dominate, yet spot volumes spike on dips, someone buying the blood. Counter that common objection. Bitcoin's correlated to stocks now, and equities are wobbling. True, beta to high-yield bonds is 5x. A 1% stock drop means 5% BTC pain. But that's the trap. It's not a fundamental shift. It's a liquidity vacuum sucking in weak hands. Analogies help here. Imagine a coiled spring under pressure. The more it compresses, the harder it snaps back. Or a black hole, pulling in everything loose before exploding in a gamma ray burst. We've seen this before. 2022 crash? Whales accumulated at $16,000. 2018, same at $3,200. History rhymes you. And the proof's in the pudding, hash rates at all-time highs, despite minor capitulation fears. Miners aren't selling, they're holding for the rebound. But the most damning evidence? The funding rates. Perps were overcrowded long before the dump. Basis at 1.42% on CME versus 0.49% retail. Institutions paying premiums to stay exposed while shaking retail out. It's hidden accumulation, plain and simple. You feel the fear? That's by design. They want you selling low so they can buy cheaper. But if this is just the setup, who's pulling the strings, and why now? Stick around, because in part 2, we unmask the hidden buyers and the megatrend that's about to ignite this powder keg. Part 2, unmasking the shadows, the who and why behind the Bitcoin blackout. If you've been following this investigation, you know part 1 laid bare the strange price action, that phantom dump from 126K to 85K, liquidations galore, but whispers of hidden accumulation through dormant wallets and whale surges. Now, let's pull back the curtain. Who are these shadow operators turning a crash into their personal shopping spree? And why is this trap springing now in December 2025, when the world screams bear market? First, the who. It's not retail FOMO or some rogue trader. It's the whales. Institutions with balance sheets bigger than small countries. BlackRock, Fidelity, even nation-states like El Salvador adding to their stack. But the real puppet masters? Sovereign wealth funds and tech giants dipping toes into crypto reserves. Forensic dive. On-chain analytics show addresses linked to custody services like Coinbase institutional swelling by 10% since the dip started. Strategy? They're the poster child, 650,000 BTC on the books, but their earnings cut was a smokescreen. CEO Fong Le hints at Bitcoin winter, but their $144 billion cash reserve screams preparation for more buys, not sells. Skeptics chime in. But Strategy's premium collapsed. They're in trouble. Nah. That's the objection they want you to buy. The discount to NAV, it's a liquidity trap for shorts. MSCI might boot them from indices January 15th, forcing $2.8 billion in sales. But that's paper hands, not the core holders. Real whales use this noise to accumulate. Analogize it to a concrete floor in a collapsing building. Prices hit rock bottom, but the foundation holds because smart money knows what's coming. Now the why, connect the dots to the macro crisis brewing, global liquidities tightening like a noose, Feds ending QT but no flood yet, rates still high, yields creeping up. BOJ's December 19th hike? It's the spark, unwinding yen carry trades that funneled cheap money into risk assets like BTC. Inflation's sticky, tariffs from Trump 2.0 disrupting supply chains. Energy crunch? AI data centers guzzling power, pushing miners to pivot. But that's opportunity disguised as crisis. Bitcoin's the hedge. Think black hole again, sucking in fiat as dollars devalue, or a loading spring, compressed by macro headwinds, ready to launch. But here's the mega trend. Institutional adoption exploding. ETFs hit $100 billion AUM, up 54x from last year. Tech giants like Microsoft voting to hold BTC on balance sheets. Net zero goals. Bitcoin mining's going green, absorbing excess renewables. Real-world crisis. Fiat's failing. $38 trillion US debt. Endless printing. Bitcoin's the escape pod. Whales know this. They're accumulating because the crash is the last chance before mass adoption. Counter the naysayers. Crypto's speculative, no real use. Wrong. It's digital gold in an AI-powered world where energy and scarcity rule. This isn't random pain, it's engineered. Whales shake the tree to grab falling fruit, but every trap has victims. In Part 3, we expose the collateral damage, the zero-sum game where retail loses big, and how crowding out effects ripple through the ecosystem. Part 3, the wreckage below, collateral damage, crowding out, and the zero-sum bloodbath. If you just watched Parts 1 and 2, you're armed with the truth. This Bitcoin crash from 126K to 85K is no accident. It's a trap. Strange dumps masking whale accumulation, unmasked players like BlackRock and Strategy loading up amid macro squeezes like BOJ hikes and Fed tightening. But traps don't spring without casualties. Now, we dive into the wreckage, the collateral damage, the crowding out, the brutal zero-sum reality where winners feast on losers' bones. First, who loses? You, the retail holder, if you panic? Liquidations hit $1 billion in 24 hours, longs wrecked on the way down, shorts trapped on fake bounces. It's a war zone. Leverage turns small dips into personal apocalypses. Miners, Riot and CleanSpark, saddled with debt, pivot to AI data centers but bleed cash. Their hash power drops 15%, forcing sales at lows. Analogize it to a vacuum cleaner in a dust storm, sucking up weak players, leaving only the strong. Crowding out effects? Massive. Institutions gobble liquidity, pushing retail to the sidelines. ETFs now hold 5% of BTC supply. BlackRock alone inflows $50 billion. That crowds out smaller players. Premiums vanish like Strategy's collapse from 2x to 1.2x NAV. Zero sum? Absolutely. Every BTC whale buys is one less for you. Tech giants entering? They crowd out alts. Ether down 36%, Solana struggling. Connect to big trends. AI boom demands energy, but net zero pushes costs up. Miners without green tech? Crowded out, bankrupt. Supply chains disrupted by tariffs? Crypto's borderless nature wins, but fiat-tied assets lose. Objection time. But everyone's hurting. It's a real crash. Nah, that's the lie. Institutions thrive on volatility. Retail gets shredded. Forensic proof. Whale wallets up, retail addresses down 8%. It's like an iceberg. Surface chaos hides underwater stability. Or a black hole event horizon. Cross it and you're gone, but the core grows stronger. The pain's real, but temporary. Losers? Leveraged degens, overextended miners, fiat holders watching inflation erode gains. Winners? Patient stackers. But the trap's about to snap shut. In Part 4, we map the breakout, the vacuum upside, technical targets, and how to hold through the storm. Part 4, the snapback, breakout vacuum, targets, and the mindset to hold the line. If you've been with me through Parts 1-3, you see the full picture. The phantom dump as accumulation trap, whales like BlackRock engineering it amid macro pressures, and the wreckage claiming retail and weak miners in a zero-sum grind. Now, the payoff, the breakout phase. When the spring uncoils, the vacuum sucks prices higher and the real move begins. But holding through? That's the psychological war you must win. First, the mechanics. This crash compressed Bitcoin like a loading spring. Now watch it launch. Technicals scream reversal. RSI oversold at 35, mirroring 2022's bottom. Support at 85K holds like a concrete floor. Targets? First, reclaim 100K, the psychological barrier. Then 126K ATH, but don't stop there. Power law models point to 175K by mid-2026, fueled by halving scarcity. Vacuum effect? Shorts get squeezed, stop runs cascade as prices rip through 90K resistance. It's a black hole in reverse, expelling energy in a supernova. Connect to trends. Fed cuts in December. Liquidity floods back. BOJ hike? Short-term pain, but yen strength boosts global adoption. AI energy demands? Bitcoin mining absorbs it, turning waste into value. Net zero? Crypto's the green hedge. Objections. What if it drops to 70K? Possible, but on-chain shows bids stacking there. Another trap layer. Psychological advice. Zoom out. Fear's the enemy. Set rules. No leverage. DCA dips. Ignore noise. Remember 2020? Crash to 4K, then 15x. This is historic. The shift from fiat to sound money. This move's inevitable. Whales set the trap. Now they spring it. The liars said crash. Truth says opportunity. Stack, hold, win. If this investigation opened your eyes, hit subscribe. More intel coming. Let's ride this to the moon.